bring in Todd Horwitz, who's chief strategist at BubbaTrading.com, live in Chicago, and Frank Troy still with us here. Todd, let's talk about the big headline over the weekend with those non-OPEC countries agreeing to an output cut. The big question, not just with OPEC members, but non-OPEC as well, as compliance. And it seems like you're already skeptical here. You say within 2 to 3 weeks, someone will not honor the deal. How do you expect the markets to respond to this deal?
Good morning, Akiko. Good morning, Frank. Look, this has been tried before, and we've tried. We're still trying to manipulate markets and not really have true free markets. And what we're really going to see here, I would venture to say that some of these nations won't cut at all. How are you going to check whether they're cutting or not? The U.S. can pump as much as we need to exist here, so it's not going to affect us at all. I see that the prices have gone up and accounted for the best of the deal, and I think we're going to end up with the worst of the deal. I think we're going to see prices fall pretty dramatically here until we get back down around that $40 level. I don't think we're going to see a massive up move. We might see an up move tonight, tomorrow, but overall, I think we see prices coming lower because there's still plenty of supply, and there is no way some of these smaller countries, and including Russia, which is not a smaller country, that are going to really cut back, in my opinion. I don't see it happening, and even if they did, it's only 2% of the production, so I don't see a reason for this to be a price mover to the upside.
So, Todd, did I hear you say you expect it to be around $30 to $40 a barrel? You don't expect it to top 50?
Well, it's over 50 now. I think we're going to see 40. 40 has been my target for quite a while, and that's where I expect this to go before I would even think of buying and going to the long side of crude.
Todd, just a quick question. I'm going to provoke you here as a New Yorker to a Chicago guy. I mean, a while back, just a few months ago, everybody was talking about how oil was 100% correlated to the move in the equity markets and that we would see a subsequent bid. You've been very, very outspoken that equity valuations are too high here. Let me play devil's advocate with you. If Trump is half as effective as we believe he will be and inflation comes back in, couldn't we see a continued bid in equities? And by default, couldn't we see a continued bid in oil?
Well, those are both great points, except that I already think that we're well overvalued. And if Trump can get what he wants, again, I love Trump. I picked him a year ago and thought that he would win, so I'm a big fan. But even if he can do everything he says he's going to do, what's going to happen to the old debt we're still sitting on? What's going to happen to the lack of jobs we still have? You know, we can hear about Obama telling us how many jobs he's created of 10 million, but I venture to say that we've lost more payroll than we've gained, even though we've gained more jobs than we've lost, because the amount of money people are making is less. The participation job is less. So overall, Trump can get this done, but it's going to take a long time to extend. And we're already trading well over, I think, what, 19 or 20 times next year's forward earnings. It can't exist at these levels. Now, again, I'm positive of the market. The market's going to go up 9% year over year. But in here, there is no way that I'm adding new money unless I'm hedging it when I'm buying it, because I think we have a much bigger sell-off coming. And I think it's going to get really ugly. The longer we extend, I think the worse it's going to be.
We'll have to leave it on that note. Todd, always great to get your insight. Todd Horwitz joining us from BubbaTrading.com.